The invest what's left over fallacy. Why waiting for surplus rarely builds wealth. Many people say, I'll invest whatever is left at the end of the month. It sounds responsible. It sounds cautious. It sounds practical. In reality, it often leads to investing nothing. 1. Spending expands to available income. Human behavior follows a simple pattern. Spending adjusts to income. Without a predefined investment rule, lifestyle slowly expands. Small recurring expenses accumulate. End-of-month surplus disappears. Behavioral economist Richard Thaler showed how mental accounting influences consumption. Once income is mentally categorized as available, it tends to be used. If investing depends on leftovers, it depends on self-control under fatigue. 2. Decision fatigue at month-end. By the end of a month, individuals experience cognitive fatigue, financial uncertainty, emotional bias from recent spending. Research by Daniel Kahneman suggests that repeated decisions reduce mental discipline over time. Investing requires forward thinking. Month-end decisions are often reactive. This creates inconsistency. 3. The illusion of responsible timing. Waiting for leftover money feels prudent, but it quietly prioritizes consumption, comfort, flexibility, over asset accumulation, compounding, financial independence. Wealth building requires reversing that order. 4. Lost compounding time. Markets reward duration. Long-term participation in indices, like the S&P 500, has historically benefited those who invested consistently and early. When investing becomes irregular, contributions shrink. Timing becomes emotional. Compounding slows. Missed months accumulate into missed years. 5. Psychological friction. When investing depends on leftovers, each contribution feels optional. Skipping a month feels harmless. Inconsistency becomes normal. Optional behavior rarely becomes disciplined behavior. Systems outperform intentions. 6. The structural reversal. Pay yourself first. Instead of spend, see what remains, invest. Wealth builders follow. Invest, spend what remains. This removes negotiation. It turns investing into a non-negotiable fixed expense. 7. The hidden cost of waiting. The leftover approach introduces consumption priority, delayed capital deployment, reduced savings rate, lower financial resilience. Over time, this gap compounds. Not dramatically at first, but exponentially later. Why the fallacy persists? It feels flexible. It feels safe. It avoids commitment. But wealth rarely emerges from flexibility alone. It emerges from pre-commitment. Final insight. Investing what's left over assumes surplus appears naturally. In reality, surplus must be engineered. If investing depends on leftovers, it competes with lifestyle. If investing comes first, lifestyle adjusts. And over decades, that order makes all the difference.